Today, we will talk about the meaning, overview, and examples of gross yield. The gross yield of an investment is its profit before taxes and expenses are deducted. It is expressed in percentage terms and is calculated as the annual return on an investment divided by the current price of the investment. Gross yield is a measurement used for many investments including real estate, fixed income, and mutual funds. It is an important way to measure the return on an investment, but it's not the only way. For example, for rental property, the difference between gross and net yields can be significant due to operating expenses like maintenance, insurance, and property taxes. Mutual fund investors also need to watch the difference between gross and net yields to make sure management and brokerage fees are not significantly impacting their real returns. Nominal yield is the coupon rate on a bond divided by its par value. It's the interest rate that a bond issuer promises to pay bond purchasers. The nominal rate is fixed and applies for the entire life of the bond. It may also be called the nominal rate, coupon yield, or coupon rate. The current yield of a bond equals its annual earnings divided by its current market price. It represents the return an investor would expect if the owner purchased the bond and held it for one full year. Yield to maturity is the total return that a bond is anticipated to earn if it is held until it matures. It's a long-term bond's yield expressed as an annual rate, and can be thought of as the internal rate of return, IRR, of a bond if the investor holds the bond until maturity and receives all payments as scheduled. Yield to maturity is also called the book yield or redemption yield. Mutual fund yields are reported in two ways: dividend yield and SEC yield. Dividend yields are expressed as an annual percentage of a fund's portfolio income, also based on the net income after the fund's associated expenses have been paid. The SEC yield is based on the yields reported by particular companies as required by the Securities and Exchange Commission, and is based on an assumption that all of the associated securities are held until maturity. Here are three key takeaways. 1. Gross yield is the overall return on an investment without deducting taxes and expenses. 2. Gross yield may be used to compare the relative returns of various investments including bonds, mutual funds, and rental property. 3. Net yield is the real return to the investor. Hope this would help. Thanks for watching.